This is episode 1 of my DSCR loan series, where I show you how to use these loans safely and profitably in 2026 and beyond. Interest rates are finally starting to come down as we head into 2026, and in a lot of markets, home prices are softening. That combo is powerful because properties that didn't have cash flow in 2022 or 2023 are suddenly starting to be in the green for investors. I'm Brian Quigley with Beacon Lending, and in this first video, I'm breaking down what a DSCR loan is, who it's really for, and why this 2026 window could be one of the best times to lock in long-term rental properties that pay you every month. What DSCR is and why it matters. Let me explain DSCR in simple terms. It's the property's income divided by the total monthly payment. Principal, interest, taxes, insurance, and HOA if there is one. And that single number tells you how profitable or unprofitable the property is. When the DSCR is 1, the property is basically just covering the payment. When it's 1.2 or higher, you've got a cushion. And as rates drift down and prices soften in 2026, that cushion gets easier to achieve. DSCR loans can be used to purchase condominiums, townhomes, modular homes with ADUs, and single-family residence from 1 to 4 units. I can walk you through a quick example of a deal that didn't work at higher rates, and then show how with slightly lower rates or a small price discount, the DSCR flips from negative or break even to positive cash flow. Higher loan amounts are better for short-term rentals. So if we're to look at this in the easiest of examples, if you're a first-time investor and you want to buy a single-family residence with a tenant in place, the tenant is paying $1,200 a month rent. Your mortgage payment is $1,200. Well, what happens in a higher interest rate environment, you're going to have to figure out how you're going to get to an area to where you can still have that 1-to-1 ratio. So at high interest rates, it creates situations where you need to either put more money down or buy the interest rate down. And that creates a negative DSCR, and that's not good for a first-time investor, especially who's just getting started out. Who DSCR loans are for? DSCR loans are designed for investors, self-employed business owners, entrepreneurs, perhaps even you. Instead of grilling you about your W-2 income or every line on your tax returns, the lender is asking one key question: does this property pay for itself? That makes DSCR loans perfect for self-employed borrowers, investors with a lot of write-offs, and people who want to build a portfolio without being boxed in by traditional lending rules. A lot of today's investors are buying in markets they never visit. They're doing their homework online, walking the property through virtual tours, and then handing the keys to a property manager to handle tenants and maintenance. That strategy can work beautifully, but only if you're disciplined about the numbers. Be realistic. Rent, real expenses, and a DSCR that holds up even when something goes wrong. So basically, I have a client who lives in Texas and bought a property in North Carolina and never saw the property. He did a virtual tour, loved the property, loved the numbers, did the projections. There was actually leases in place, and he was able to acquire that property sight unseen and also hire a property manager to manage the tenants. The property was also in a college town, so location is definitely key, especially when you're buying properties that are not in your backyard. So is it near a hospital? Is it near a college? Are there going to be consistent tenants in there that are going to be very reliable in terms of being able to pay? Another example is a client who is purchasing a property for an Airbnb, and they think they can cash flow a lot on this property based upon AirDNA data and what the property is projected to rent at. They're not actually looking at hard data. They're not looking at a 12-month rent roll or hard data from the seller or listing agent, they're moving forward into a situation which is very exposed with no factual numbers. In that situation, that deal did not close, and that person was not able to buy that property because the projections did not make sense. In a 2026 environment with lower rates and more motivated sellers, DSCR loans are a tool. Used wisely, they help you control properties where the income supports the debt, even if your personal income is a little messy on paper. But just because you can get approved doesn't mean the deal is safe. Before you jump into any DSCR deal, you need to do your research. In the next video, I break down the dark side of DSCR loans, fantasy rent numbers, hidden expenses, and the sight unseen risks that quietly kill cash flow.